Welcome to this week's strategy session. Great to have you with me. Lots of interesting things to talk about today. Little bit different today because of the Australia Day holiday on Friday. We've brought everything forward and we're doing this on Thursday. And I'm also going to do one video. So I'm going to combine the US coverage with the usual ASX and commodities, which we'll get into a little bit into this. So first of all, everything today is general commentary only. No personal advice given. It's general commentary only. So having said that, I think it's time we get into our first chart for the day. So let's start off with the SP 500 because there's been quite a bit going on. A strong week in the SP 500. It's put on 4% since Wednesday last week. So that's a strong week. And we spoke about this possibility last week. We spoke about the possibility of the market lunging at the all-time high, because like here's the all-time high from January 2022, and we're in such close proximity that it's just such an obvious target, or such a close target for the market to have a run at, and that's what it's done. It's run up and hit that all-time high. So there we go, a new all-time high in the S&P 500. My concern last week, and that carries over into this week, it's whether the S&P's done enough consolidation just over the few weeks prior to the latest run, whether it's done enough consolidation to sustain another large rally, because this was a big rally off that October low. So is 4 weeks of consolidation enough? And there are a few interesting things to go through and have a look at when we try to assess, like whether we have done enough consolidation, whether this rally can extend. So the first thing is the positioning of the moving averages. And one of the things I look at how far the market's run since the last time it came back and touched the 50-day moving average. So far we've got a 14% rally since crossing the moving average, since crossing the 50-day average back in November. And a 14% rally, it's not without precedent that we get these big runs above the moving averages, but it's getting towards that upper end of where the S&P will typically run before coming back and having a test of the moving averages. And also another thing I do, like putting on an RSI at this point in time. Often don't look at the RSIs, but just when we get to elevated levels, either to the upside or the downside, that can be useful. So this is a 14-day RSI, and what we see when we look at this, it's divergence. We've got a new high in the S&P 500, and the RSI is nowhere near making a new high. So that's one of those indicators you look for sort of seeing is a market, how sustainable is a market's rally. And when you get divergence, it's often a sign that the market's going to be close to running out of steam and needs some sort of pause. So look, I think that's an interesting thing to consider, the positioning of that RSI. So let's just take this little bit off for now. So and I think there's also signs that this rally is getting a bit narrow. So just quickly jumping across to the S&P 500 equal weight, and where the S&P 500 has made a new high, you see the S&P 500 equal weight hasn't. So that's that sign. That's that sign that all the stocks aren't firing off to new highs with the S&P 500. It's actually a big portion of the rally over the last month has been down to two stocks, and that being Microsoft and Nvidia. It makes up something like I read earlier around 80%, or around 60%, coming up to 60% of the gains over the last 2 months, or the last month, has come from those two stocks. And this is partly why we're getting this divergence now. So the equal weight not making new highs, but then you go back to the NASDAQ, and the NASDAQ is making new highs. So we've got a couple of areas of divergence. I thought it'd be interesting just to have a quick look at Nvidia. And because this is an interesting stock chart just to check out. So we had a big sideways consolidation that went on through much of the second half of last year. And then we had another tighter compression band. So we had a rally off the lows in October, went into a tight compression band over a couple of months. And just since the start of the year, NVIDIA's had another strong rise. And this has really helped fuel this run in the S&P, along with what Microsoft has been doing. So on the whole, it's definitely an upward trend. You're not looking for a top in this. It's an upward trend coming out of a sideways range. That's all positive. Just from on a near-term basis, it's interesting when I was having a look at the volume profile. So the volume increased on the breakout, but it's generally been decline during the last couple of weeks, last 2-3 weeks of the rally. So look, that's an interesting thing in itself, in that maybe the trend is in NVIDIA is due for some sort of a pause and a pullback, which of course then flows onto the SP500. Just coming back to the S&P, what I want to be clear about this. I'm not looking for a top in the S&P 500. So don't get me wrong. I'm not trying to call a top in this market. I'm just trying to manage what I believe is probably an increasing risk of some sort of a meaningful consolidation of this large rally that we've seen over the last couple of months. It's a strong run, and strong runs often lead to pauses, they lead to pullbacks. And I've said over the last couple of weeks, I don't think this is an asymmetric entry point to the S&P 500. But with that trend undeniably to the upside, I think the play here is not to try and pick a top, but to keep holding stocks that have been rising, and then use a trailing stop loss and give them plenty of room to move around. So then hopefully being able to see off any consolidation should that develop. And if the consolidation doesn't develop and the market keeps charging higher, well, those positions remain in place. I think that's the best way of keeping upside open whilst being able to manage risk, and then just being cautious around new entries, adding exposure at these elevated levels. Now, I want to jump over and have a brief look at the Russell 2000. It's just an interesting contrast, because the Russell's continued to consolidate below the December high. So we've got the S&P 500 and also the NASDAQ breaking to new all-time highs. The Russell, being the small caps, hasn't been able to get back to its December high at this point. It's already retested the 50-day moving average, encouraging that it has bounced off that in the last couple of days. So I think that's a positive. I think we want the dip to find support around this region, around the 50-day, around the 100-day moving average, and I think to keep the scenario that this is a large basing pattern, which is now starting to move upwards. To keep that scenario in play, I think it's important that we see buying interest coming in around about where the low was this week, underpinning this pullback. What would be great to see would be if the Russell can stay in the top half of this big range, which is really held up for the last 18 or so months. If it can stay in the top range, like if it could consolidate within this sort of band here, what that would then potentially do is set up a platform for a sustained rally that could then develop in the weeks or maybe the months ahead. So I'm optimistic. We can see higher levels in the Russell as we get into the year. Now, if you're getting some value from this, please hit that like button, leave us your comment, just, hey, thanks for the video. Let me know whether you like the format, whether I'm helping with what you're doing. That would be really good. Helps me, helps the channel, and just lets me know what I'm doing is making a bit of a difference. And also hit that subscribe button if you haven't already done so. Now, let's move over to the Aussie market before moving into some commodities. So, got the ASX 200, and this has been an encouraging week. Last week we spoke about the lows, the recent lows being a point where we really needed to see some buying emerge to keep the encouraging setup, which seems to be developing, to keep that in play. And that's been what's happening. The buying has emerged around this 50-day moving average. We've had a nice move back up to just underneath this key overhead resistance around 7,640. And there are a couple of reasons we were looking at this area last week, and a couple of reasons why I was saying it was important. And one being, as I was saying, about that moving average, where the 50-day moving average is, and also secondly, and just put the Fibonacci retracements on, which are always which are often a nice guide to where a market might come back to and find support. And so we found we had this cluster of supports coming in around where the low is, and so that's been a useful area to watch. I think so far the price action from the high, I think so far this price action is looking corrective, and it's corrective in that we had a strong rally off the lows, but now we're seeing this choppy overlapping sideways price action. And you can see the difference. This is an impulsive rally where the highs and the lows, they don't overlap one another. They just keep pushing higher. And then when you get this overlapping sequence, that's where you're often seeing a consolidated period where a market's moving sideways. So it's encouraging to see a consolidation following a strong upwards move. And just looking at the price action, it doesn't look like it's done enough work yet. At least to me, I just don't know. I don't think this has done enough work yet. I don't think it's built the energy that's going to be required to make a sustained break above this overhead resistance, because it's such a big level. It goes back to 2021, but really only had our first test of that resistance. I think it'd be quite normal to see the market take a bit more time. I think, as I said last week, I think the ideal scenario would be for the ASX 200 just to coil up a bit over the next few weeks, maybe over the next month or two, around that moving average space, build up some energy, and then have a punch to the upside, and hopefully then get that sustained breakout. I think that would be the ideal type of scenario, some sort of a tight compression range, and then that sets the stage for the breakout. But of course, look, that's just a possibility. It doesn't, the market, of course, doesn't really care what I think would be ideal. It's what it does could be something entirely different. And so that's why, as I've been saying over the last couple of months, I think the play here, given we've got this momentum off the lows, I think the play here is I think we want to be long stocks, and I think we want to see where this upward momentum takes us, notwithstanding the possibility of some consolidation. And I think the way to play that upside is using wide trailing stops to help see off any potential further consolidation, but also giving us an escape path should the markets break down and not follow through to the top side. And I think the important point about this sort of strategy is that it helps. Well, this is what it's doing for me, at least anyway. By using these trailing stops on my positions, it means I'm positioned if stocks run now and we don't get a consolidation. If we get a consolidation, it helps keep me in the market while we wait for this period to end and then maybe break to the top side. But if the market doesn't move high and instead rolls over, I've got that escape path. I've got this way out. So that's the way I'm playing it. I think it's probably the best way at the moment to keep upside open whilst managing risk. I'm not rushing to add a whole lot to my portfolio at the moment, with the ASX 200 just beneath this key overhead resistance. Not really what I'd call an asymmetric entry point after such a big run, sort of like, going, okay, now's the time to get in. I don't think that from a risk reward that really stacks up. I want to wait and see whether we get consolidation, or wait and see whether we get a breakout before really adding too much more. That said, though, I'm still considering individual stocks all the time when I'm seeing the setups, I'm seeing the breakouts. If the setup looks good, I'll have to consider it, even with the index where it is just below resistance. But yeah, look, I wouldn't be buying an ASX 200 ETF at this point in time. Now, I'm going to move on now and have a look at the small ords, small ordinaries. Interesting stuff happening in that section of the market, and then also the commodities. Some interesting things to talk about there. I've got a couple of stocks. I've got a big cap and I've got a small cap to talk about. So something for everyone. So I think that's going to be interesting too. But that, of course, wraps up the free section. So if you're not a strategy session member, think of coming across. There's a link below this video. Click that. Not very expensive at all. It's really a low-cost entry into this world of chart analysis, trend analysis. The algorithms I use to identify the stocks, which I'm talking about later, it doesn't cost you much at all. It's really like buying me a cup of coffee for prepping the rest of the session for you. So, okay, now let's move into this. Let's